Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, August 1st, 2014. And in this video, I wanted to cover the insurance sector and touch on the financial sector, look at XLF, the financial ETF, real quick. I had mentioned in a static post, an update last night, that the insurance sector, in my opinion, looks poised for a nice correction. And what I wanted to do is just go through a few of the top holdings in that sector. I have to leave town either tonight or early tomorrow. A friend of my wife has passed away, so I'll be out, not returning until probably late Sunday evening, and therefore I'm not sure I'll be able to get a lot of static charts mocked up, the live chart links and some setups. So what I'll do here is cover those charts real quick in this video. You can pause, take a look at the charts. If you see any you like, go ahead and replicate those trend lines and support levels on your own charts, just in case we do see some fireworks next week, which is likely. All right, let's go ahead and start out looking here at the KIE. That's the Spiders KBW Insurance ETF. We're looking at a daily chart. This is the same chart I put up last night in the static post. As I mentioned, let's highlight this 200-day moving average a little bit better. This goes back for quite a while. This is the 200-day moving average. I mentioned that being number one, we're in close proximity to what, had I gotten this out earlier, I'd mentioned the insurance sector is one of the more bearish-looking sectors back here a week or so ago, but I didn't put it as an official trade idea. Now that we're close to what would have been my first target, this level here, I've resequenced those targets. We're going to need to see that level go, and more importantly, this 200-day moving average, as you can see, and that's the red line we're talking about here. The KIE has done a great job of catching support. This line has acted as support and resistance. Again, the red line, not the white trend line. And if we look at, let's zoom into what happened today. And this is why I often talk about waiting for daily closes below such key support levels. If you follow, I'll put the cursor on today's candlestick. And if you look in the upper left-hand corner, I can't drag and highlight that now where I leave the candlestick, but it pops up there that shows you down around the middle in red, 200-day EMA is at 6109, and at the very top in green you see the prices for KIE at 6105. So essentially what's happened today, we hit a low of 6084, and that's what we call a bear trap. Those who had an alert set to short KIE under the 200-day moving average. So far, we'll take a look at a 1-minute chart. The stock broke below, or the ETF, and it's a thinly traded ETF. This is a 1-minute chart. You can see we had a nice break below, but so far we're rallying back up towards that level. So being the fact that the markets are at or near some of my key target levels, the first downside target on the SPY, we're right around or just under that level now, and everything else I mentioned last night. I'd just like to see some follow through to the downside next week. I do expect that level to go. But more often than not, from my experience, the initial tag of a key support level on the downside, you almost always see a reaction. And a reaction being defined as either a bounce or a pause or consolidation around that area. So best to give it a day or so, and let's see that 200-day moving average solidly in the rearview mirror. If we look at a 2-day period chart, now, the 100-day EMA on a 2-day period chart, where every candlestick represents 2-day action, that's the same as a 200-day moving average, and this is what I'm talking about. This line only started populating right here, but back here it was acting as resistance, 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 boom, broke above it, and there's a bull trend. Prices came, really struggled, traded through that level for a while, but once the uptrend was well underway, as you can see, boom, 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 prices have found support. So again, when I factor moving averages into my analysis, I don't just say for the sake of a popular moving average such as the 50-day or 200-day, whether you're using a simple or an exponential moving average. I don't look at those as support or resistance level unless I've seen past history, especially recently, reactions off that level. In other words, if I were to look at this chart back here just at this point in time and I see prices trading through the 200-day like it's not even there, then I'm not putting a lot of effort. That you'll just be whipsawed in and out. But once you get and of course this was a consolidation range, but once you have an established trend, then I put a little more stock into that. So in this case, we're watching that 200-day. We have some horizontal support here at S1, and then the downside targets. Really what we're viewing here is here's our primary uptrend line. We had a breakdown and a retest. Let's zoom in a little there so you can see the breakdown right here, the back test for a few days, and then boom, an impulsive move lower. That trend line had a divergent high, which formed this rising wedge pattern. And as I mentioned, let's go ahead and dive into the components of the KIE. Before I do that, take a quick look at XLF. This is obviously a much more liquid ETF than the KIE. The XLF being the Spider's Select Financial ETF. This has insurance as well as banks, REITs, anything financial related. So the insurance ETF we were just looking at really is a small part, if you will, of the XLF. But this chart, although I'm looking at it on my TC2000 charting program, is really a replica of the ETF charts that appears under the live chart links page. So you can take a look at that. And as you see, we clearly today have a breakdown. And as I've been stating lately, financials, in my opinion right now, have some of the most promising short trades when I look at some of the individual components, both from a fundamental as well as a technical perspective. I think we have a good shot here at a pretty decent correction in the financials. Again, like the insurance sector, the XLF had a divergent high. But let's go back to KIE, and I'll try to run through these pretty quickly. One feature I like about TC2000, although it does have its limitations, which I'll talk on in a minute, is this feature here. When you look at a ETF, you simply click on this box and it immediately gives you all the holdings. Here's all the components. The KIE actually has quite a few, as you can see here as I scroll down, or I could lengthen the box. There's quite a few, but we'll only go through about the top dozen or so today. And what I like to do in these ETFs is sort by market capitalization. In other words, we'll go from the largest down to the smallest. We'll only take a look at the top holdings. Here's AIG coming in at 76, almost 77 billion in market cap. So that's the behemoth in the sector, or at least the biggest by market cap. Sometimes, but not always, if you sort by market cap, you're sorting by the components in descending order. At times, certain ETFs or indexes will have different weightings, and they may have, the largest market cap stock may not necessarily be the largest holding, but for the most part, the top 10 holdings here in the KIE should mirror the top 10 by market cap, give or take a few. So let's go through and look at AIG first. I'll just run through these one at a time. I'm going to move that off the screen. Here's AIG from a daily perspective, and we see this trend line break here, a back test. This was a nice, well-defined uptrend line, and admittedly, I have screamed fire or cried wolf on the financials a few months back. Put on some short trades on a lot of the big banks. I don't believe I did a lot in the way of insurers, but it looked like we were going to have a top in the banks and in the financial sector back here. We had a divergent high, trend line breaks, et cetera, et cetera. But this is one of the rare times that I've seen such clearly defined divergences and trend line breaks like this go on. We back tested, fell. So yes, there was a correction. There was a little bit, but not much to be made. For example, if you look at AIG. Now, I don't believe I had AIG as a trade. I'm just speaking really as the financial sector as a whole. This is what AIG has done since then. We have this nice, well-defined uptrend line and a breakdown there. Let's take a look at a weekly chart real quick. Not much there, so we'll go on to the next name. And this is MetLife. Now let's go ahead and look at a 2-day period chart. Well-defined uptrend line, divergent high. One of the limitations of TC2000 is the daily time frame charts only go back a period of 2 years. So to look back a little farther, you have to go to a 2-day period chart. And in doing so, that will often slightly alter the trend lines and annotations that you made. But for the most part, I do that so we can see that this trend line generated back here in the middle of 2012. So we have a nice bearish rising wedge pattern. Prices are right at that key support line right now, as well as the 200-day moving average. So that one looks like it has some promise down to about this level. If and when that trend line breaks, we're talking somewhere around $47 would be the first target on Met. Okay, next up, we're looking at a 2-day period chart of Prudential PRU. This is the third, or I'll move this back over here, the third heaviest weighted, at least by market cap, the third largest component of the KIE, of the KBW Bank Index. And here we have a nice uptrend line, multiple touches here, here, here. We've also see, again, we're looking on a 2-day period, we're looking at this 100-day EMA, which is a 200-day moving average. And although in the past it didn't do such a hot job, there were a few reactions there. It has done a decent job lately. Either way, the fact that the 200-day comes in with this trend line, you're going to see a break of both those. If it does happen in the near future, both those support levels will give way. Looking down below at the MACD. Sorry, let me move this chart up here. Okay, there we go. Fix that. Took the volume off, added the RSI to show the divergence, almost a divergent high. This was virtually an equal high back with this peak here, although this one I can see was just slightly higher. But the same net effect, considerably lower highs on both the MACD and the RSI against these, roughly equal highs. So you're looking at a divergent high, a stock that is more than doubled just in the last, less than 2 years, and now is challenging a significant uptrend line. So there's Pru. Let's see if I have any downside targets on the daily chart. I haven't marked any yet, but I could add. I can see, taking a look at these reactions here, as well as this volume at price histogram. I do have the colors tuned down quite a bit. You may be able to make that out on the video. The green and red bars, as you can see, it's very thin below this level here. So if and when Pru were to break that support level, the lower end of that range really would be these reaction lows right here. This is sort of a support zone down here around 77 something, maybe 77.50 to about just below 74. If things do get really ugly in the sector, it is very thin all the way down to about the $61 level, and that's Pru. This is symbol ACE, ACE Limited, and we're looking at a trend line going back to the fourth quarter of 2011. Multiple touches along the way. We had an impulsive breakdown here. This helps to validate a trend line when you see that big red candlestick, the selling that took place once that trend line had a sustained break. This was a little whipsaw. You can see some candlestick wicks where prices broke down intraday and probably closed right back on or above the trend line there. So that trend line really held until this point. Some impulsive selling. And then, as I said recently, this looked like a nice top back then in the financials, and prices went on to push higher. And in doing so, it depends on your perspective of the market. Those bullish might say, "Oh, that's a very bullish event because it's a fake down, a bear trap. We broke support, but prices have continued to push higher." Well, that may be a valid view, and prices may go on higher. But my read is that these highs are marginal new highs. They're divergent highs, as you can see here as I'm drawing the prices making a higher high against the most price and momentum indicators and oscillators making lower highs, i.e. negative divergence. So you had a divergent high. Once again, here's that 200-day moving average doing a pretty darn good job throughout this uptrend of defining prices. So we're sitting on the 200-day moving average now. So again, a lot of these insurance companies are sitting on very key support levels. Many have already broken below those support levels, and that's why I'm bearish on the sector. As a trader, you can either look to position long on a drop to support if you're bullish and you think there's going to be a meaningful bounce and continuation of the uptrend, or you look if you have a more bearish outlook, then you look to position short, wait for a breakdown of that level. Don't try to game the bounce off that level. Wait for the breaks below support, and then position short for a nice swing trade. I don't think I have targets drawn up on ACE yet, nor are any of these official trade ideas. By all means, if you like what you see, go ahead and trade it. As I said, I won't have time to really mock up and annotate a lot of these charts to post on the live chart links, and that's why I wanted to share these with you today before I leave town. TRV, Travelers, nice series of uptrend lines. Let's try a 2-day chart on this one. Okay, this was our primary uptrend line back from October or so of 2011. Well-defined uptrend line, divergent top. Actually, that divergence shows on the daily chart. The 2-day chart, as I mentioned, often skews these some of the trend line drawings here, especially on the oscillators. But we had a breakdown, impulsive move, back test, and then like everything else in the financial sector, we pushed to new highs. Travelers since then has had these uptrend lines. Each break has led to impulsive selling. This is the most recent uptrend line, and as you can see, prices recently broke below there, triggering a potential sell signal for Travelers. And I have some lines drawn here. Again, not official lines. I'll spend more time really looking through these charts and trying to identify the ideal downside targets if and when we get an all-out sell signal in this sector. But for now, anybody looking to initiate some, initial or partial or even full short positions, I think this sector does have a lot of downside left in it. I think we're just getting started. So let's move forward. I'll take a look at a weekly chart before I do that. Okay, nothing much there. This is Marsh & McLennan, very big insurer. This is actually 1, 2, 3, 4, 5. Looks like number 6 at about 28.5 billion in market cap. What we're looking at here, again, here's our 100-day on the 2-day period, which is the 200-day moving average. More focus on this uptrend line. The orange uptrend line has done a very nice job of defining the uptrend all the way back. Like most insurers, since the second or third quarter of 2011, divergent high, negative divergence, and prices starting to move down now. So on that one, you'd want to wait and see a break of the trend line and or the 200-day moving average. Personally, I'd wait for a solid close below the trend line and probably initiate a short there. These are a few potential target levels, and again, these aren't official. I'll try to update these as soon as possible, as well as take my favorite picks out of the sector. Now, I wanted to reiterate, I'm not cherry picking the charts here. I'm not looking through the KIE and finding a handful of bearish charts just to justify my case that I think there's going to be a drop in the sector. What I'm doing here is looking at the holdings in order from the largest market cap, working my way down. We're just going to cover about the top 10 or so. So the fact that so far we've gone through 6 of these, and I can make a bearish case on all of those, or a potentially bearish case, tells me something more so than just taking a look at the sector and pulling out a handful of the most bearish stocks where the vast majority might still have bullish chart patterns. AFL, this is Aflac, with the duck commercials, and Aflac had this nice uptrend line also, like most of the insurers going back to the second, third quarter of 2011. Prices broke below that uptrend line. We've had this nice horizontal support shelf here, this horizontal line at you can replicate these again on your charts, call it 60-70-ish, 60-60 maybe, 60-50, somewhere around there. And we've just recently had an impulsive breakdown below that level. So my next target, we do have a reaction low here around 57.50. So again, maybe want to hold off on this one for now. Ideally, I'd like to see a bounce back to that former support now resistance level at 60.50, somewhere around there. That would be a great area to enter take a short entry with a stop not too far above, and we may get a reaction here around that previous reaction high right at this point, and ultimately we have a nice support shelf here. So either way, it looks like more downside to come in that one over time. This is AON. This one is actually an active short trade on the site. It was posted back, I believe, on July 25th. So about a week ago as a short on a breakdown below this uptrend line. Again, you can reference the actual live annotated chart from the site via stockcharts.com, one of those links. So far, so good, playing out well. The sole and final target at this time is 77.08. That's on this horizontal line. And we can see nice divergent high, rising wedge pattern, negative divergences in place. We have to go back on this one to a 2-year chart to see where that trend line begins. And as I talked about, this is one of the limitations when you go to skip over to a 2-day time period. It sometimes alters your lines, but you can still see that divergence clearly. So there's the chart from a longer term perspective, a 4-year 2-day period chart. So nice looking one with plenty of meat left on the bone. Like everything else, coming up on its 200-day moving average. So, in fact, we're getting that reaction today. I'm watching the KRE trade as I do this video, and it's not bouncing as much, and that's a good sign. So far, the markets have found support at their lows today and have climbed, retraced quite a bit of the losses. The KRE is still hovering near its lows right now, and I'm talking about the KRE, the banking index. And let's take a look here. Yeah, and I was just looking at the KIE. That's had somewhat of a retracement too. And as I said, that hit the 200-day, as I talked about earlier. So that was a key support level on the KIE, the KBW Insurance Index. So let's see if the next week or two takes us below that level. If so, that should open the door for more downside. So this was AON, an active short on the site with again plenty of meat left to go on the bone. But as I say, if I didn't already have a position in the stock, which I do, I would not be shorting at this point with the insurance sector itself at a key support level. So far bouncing, taking an intraday dip below, but looking to close, right on or above or near that level. So you'd have to wait, ideally, to see a break below the 200-day moving average on KIE, as well as maybe on AON to either initiate or establish a short position on this one. Okay, why don't we just do two more? I think I've made my point here. As I said, there are a lot of components in this ETF, so I can't possibly go through them all in the video, nor will I be able to get to them all, at least, within by the close of business today. Try to get some up tonight if possible before I leave town. So that brings us to Allstate. We're looking at, again, a 2-day period chart here. Nice uptrend line from the second or third or fourth quarter of 2011, like most of the insurance stocks. That's where the rally was launched. Here's that 100 period EMA/200-day moving average doing its job. And since the breakdown here, again, what a fake out from the bearish perspective. I've been trading for years, and sometimes you get this. You have a breakdown and a back test, what looks like a perfect bearish entry here, and then again a re-entry here. But prices have crawled up for months, clearing out the stops, and at times that happens. That doesn't mean I'm going to give up on technical analysis. This has been the Feds have a heavy hand in this market, and that heavy hand has really been lifting the financials more than anything. And believe me, the insurance companies just every bit as much as the banks they are supporting. So, with their free money policies. So this is ALL. Regardless of my views and opinions, this is a nice, clearly defined uptrend channel. However, if you look at the channel, look at the RSI and MACD below, that channel has been diverging, making higher highs on that ascending channel. Prices have made higher highs within the channel against declining MACDs and RSIs. So, the ideal, or I should say conventional sell signal would be on a break below the bottom of this channel. However, the case, I think I've made a pretty decent case that whether it's going to take a couple days, couple weeks, we're going to start to see some, probably accelerating downside in this sector, especially once that 200-day moving average on the KBW Insurance Index goes, and if the financials follow suit, and of course the broad markets. So an aggressive investor or trader could actually establish a short entry here up at the top of the wedge. The channel. I'll often establish positions at the tops or bottoms of falling or rising wedges, as well as channels, with stops not too far below or above. Yeah, sometimes prices will ride the top of the channel, but usually not for very long. So if you get another tag, we had an almost near tag of the channel, that might be a place to establish an aggressive short entry, maybe a partial position with a stop not too far above. So that's Allstate. And finally, I'll stop here. This is Chubb Corp, symbol CB, and we're looking at a weekly chart here. Going back all the way to the bear market, the end of the bear market back in March 2009. Chubb bottomed along with the broad market here and has been in a well-defined uptrend. Again, we're looking at a weekly chart, so we've seen that started back in March of '09. We had several tags here along the way, more tags of that trend line, and then again we zoom in a little bit, we see the impulsive selling, the breakdown, back test. I mean, this is just textbook technical analysis 101. We'll see if it plays out. But you have a breakdown and back test of a trend line. You had a divergent high. It's not drawn here, but I could draw a divergent high on the the PPO, the RSI. This is something I use on my weekly charts. I didn't put up a lot of the weekly charts now, but we can see this rate of change. ROC 57 I like to use on a weekly chart. It does a great job of defining bull and bear markets, and we see that quickly declining. But what I really like about this one, let's zoom into this 2-day period chart. There's that uptrend line that I talked about, so we can actually get a little closer, look at a 1-day period chart. My apologies because I haven't cleaned this one up. Let's move this down a little bit. Again, these charts are sort of in rough draft mode where I plan to go through, shorten it down, get a short list of the names I like, and from that short list put up the most promising trades, as well as the ones I do my best to post trades very close to breakdown. I try not to put them up, if I think they're weeks or months before a likely entry. So what we're looking at on Chubb, as you can see, I just click note, and I'll fill in. This is a left shoulder, head, and a right shoulder of a nice, very nice looking head and shoulders pattern. And I've actually had this one drawn for a while now. I've been watching this. So again, I should have took the time to update it before. But I have alternative necklines drawn here. You can see, here's the bottom of the left shoulder, the bottom of the head right here after prices came down. And so I can either use this white trend line for the neckline, actually comes back and captures that reaction high, or I have this alternative slightly more upward sloping neckline. I think it's prudent to watch either, and if you want to play it on the safe side, when trading, if I can draw two trend lines that are very similar and both just as valid, I think of it this way. There's going to be traders out there. Some traders might be watching this trend line. Others might be watching that trend line. This is the safer play of the two, to wait for a break below the lower neckline, because if you were to take an entry on a break of this neckline and the majority of traders are watching this neckline, they might buy there. They might try to buy that as a support level because technically, what a neckline is a support shelf. So either way, I just wanted to point that out, the fact that not only do we have a very nice symmetrical looking head and shoulders pattern here, volume patterns are confirming. When you see a head and shoulders pattern, one of the most important things, and I believe one of the most overlooked things by a lot of traders, is to confirm that head and shoulders pattern, confirm it with the volume patterns. And what you want to see, it's not so much important, and it's really not material on the left shoulder, but you do want to see an acceleration in volume. As we're looking down here at these red increase, the increase in selling volume when prices fall off the head as well as the right shoulder, and that's certainly what we're seeing again here on the right shoulder. So far, this is a textbook head and shoulders pattern formation, and that final entry again will be triggered on the break below the neckline. So take this daily chart we're looking at, that head and shoulders topping pattern, coupled with this weekly chart. We're looking at a price move in the last 5 or so years from $33 up to $100. A clear breakdown and back test in technical analysis. It just doesn't get any better than this, in my opinion. So that doesn't guarantee the trade's going to work out. So place your stops, take trades that are appropriate with your own risk tolerance and trading style. But this I can tell you right now would be one of my picks in the sector for a long-term swing short candidate. Okay, folks, this has been Randy Finney with Right Side of the Chart. Hope you enjoy it. Have a great weekend.